I've been trading for 6 years and been managing millions in prop firm and investor capital. I'm going to compress 6 years of brutal trading lessons into this one video. So let's begin with number 1, and that's going to be: do not underestimate the power of stupid simple. The amount of information that you need to make successful winning trades right now and successful winning trades for the remainder of your life, it's probably a lot less than you could possibly imagine. You don't need dozens of indicators that are cluttering up your charts. You don't need to chase the latest shiny object that's in the market. And you don't need to know everything about the economy and monetary policy. And you certainly do not need to have an answer for every little thing that goes on within the marketplace. All you need to become a long-term profitable trader is just one simple edge. That's it, guys. Just one simple edge within the entire market ecosystem, and you can get whatever it is that you came for. Because that one little simple edge, that's going to become your domain, and you will become the ruler of that domain. And every day when you wake up, you're going to hammer on that edge over and over and over again from now until the end of time. And anything that goes on that does not pertain to that edge and what you are doing, you don't need to know about it. It's none of your business. It's just noise and nonsense. I finished every trading year with huge returns by using one simple edge every single day of the week. And after 6 years in this business, there's a lot that's going on in the market that I don't know about. But guess what? I don't have to. And you don't either. Now, one simple tip that will help you keep things stupid simple. If you are a new trader, I highly suggest you stay away from indicators in the beginning. Start with understanding price action, basic market structure, and trend. Then once you've mastered that, you can move on to the manipulation model. Same goes for all of you traders out there who have experience, but you are not consistent. Start to remove some of the noise that may be on your charts. Get back to the basics. Understand how price action works. Understand market structure and understand the manipulation model. But always keep in mind, stupid simple will always win in the markets. Alright, so lesson number 2 is overcomplicating strategies. The number one reason 90% of traders fail has nothing to do with strategy. Nearly every profitable trader I know, including myself, started the same way. Drowning in indicators, trying every new system, convinced that complexity equals profits. And I spent my first year blowing through strategies. The result was consistent losses and complete confusion. And here's what I learned the hard way. More tools create more confusion and not clarity. I once had dozens of indicators on my chart and I couldn't even see the price. So the majority of indicators out there are just based on price itself. So what I had to learn over time was, if I just learned how to read price without the indicators, then I didn't need the indicator. Price itself is going to tell you where the market is going to go. It's giving you the story, and a lot of the indicators out there are just lagging derivatives of price. You guys can ask any profitable trader out there and they will tell you the same thing, that less is more. So the strategy that made me the most amount of money has one indicator, just a couple lines on the chart, a couple rectangles, and just key levels where I expect the markets to react from. The market is already telling you everything that you need to know if you stop drowning in the noise. And this isn't just theory. This is what actually works after 6 years of trial and error. Now, you guys have probably heard everybody talking about system hopping when you first get into the markets. I want to put emphasis on the fact that you only need to master one before you try and learn another. And I didn't become profitable until I focused on just one strategy. You guys can go online right now and find 10 different strategies taught by 20 different people, and they're all teaching it differently. The key is that you stick with one long enough to find out if it actually has an edge or not. And even after all that, the biggest lever that you can pull when it comes to profitability is not your strategy. It's your risk management, your trade management, and your psychology. You could have a below average strategy, but if you have really great risk management, really great trade management, and really great psychology, you can turn that average strategy into a winner. Now, is it boring? Maybe. But is it profitable? Absolutely. The traders who commit to one approach always outperform the system hoppers. But even with the perfect simple strategy, most traders still fail because of this one critical mistake that has nothing to do with entries. If you want to see exactly what my simple high probability setups look like in real time, I put together a free ebook with my top 4 entry models. These are the exact strategies I use to make consistent payouts and achieve 5-figure months. And the best part is it's completely free. It's in the description below. Grab it when you get a chance. But here's the thing. Even with perfect entries, most traders still fail because of this one critical mistake, which is lesson number 3. Poor risk management and stop loss discipline. This single rule has saved me over $100,000 in losses. Most traders think risk management is boring until they blow their account. I learned this lesson when I lost 70% of my capital in 1 week because I knew the market would turn around. Spoiler alert, it didn't. And every blown account has the same story. Ignored risk management. So here's the math that changed everything. So you never want to risk more than 1 to 2% of your capital per trade. And everybody always talks about this. But why is that? For me, position size matters way more than your entry timing and strategy. Trading is just a game of numbers, and you need to play the game as it's been designed. In trading, you can stack the odds in your favor. If you're aiming for a 1 to 2 or a 1 to 3, you only need to have a 30 to 40% win rate in order to become profitable. But let's say if you are risking more than 1 or 2% of your account on that specific trade, if you go into a drawdown, it's going to take you a long time to get out of. And not only that, but if you lose 50% of your account, you now have to make 100% to get back to break even. Now, if you've been following me for a while, you know I like to visualize my capital in a very real way. Instead of thinking about my account as a number on a screen, I think of it like a fuel tank. With proper risk management, risking 1 to 2% per trade, let's say my maximum acceptable drawdown is 20 to 25%. That means I only have 20 to 25 units of fuel available for the entire journey. Every trade I take burns 1 unit. Now, losing streaks are part of the game. You're going to have periods where you lose 3, 4, maybe even 5 trades in a row. That's normal. But the key is this. You're still driving with plenty of fuel left. Here's where things go wrong. The moment you start risking more than 1 to 2%, it's like driving with a leak in your tank. Suddenly, after the same number of losing trades, you're not down a few units. Your fuel is cut in half. Instead of having 20 to 25 units to work with, you are sitting at 10. And if you've ever driven while watching the fuel gauge drop faster than it should, you know exactly what happens psychologically. Everything changes. You stop driving smoothly, you start rushing, you take shortcuts you wouldn't normally take, you push the car harder, trying to get to the destination faster, and that's usually how you end up stranded on the side of the road. For traders, that's when the decision making falls apart. You start forcing trades, you start increasing size, you start trying to make it back. At that point, it's no longer trading, it's survival mode. In general, that's just not a good place to be mentally. Now compare that to another driver on the exact same road, but this time their tank is still full. They're not stressed about every mile. They're not watching the gauge every second. They can drive smoothly, make rational decisions, and take the route that actually makes sense because one wrong turn doesn't threaten the entire trip. That's the difference. When you have plenty of fuel, you don't care about the next small mistake. You're focused on the journey, not panicking about every moment. And that's exactly how disciplined traders think. They're not attached to the next trade because their risk is already under control. And it's the same thing with position sizing. If you are taking positions and you are finding yourself making poor decisions, or you feel like you're about to make poor decisions, then trade smaller. You're not quite ready yet to be trading the bigger sizes. So just remember that your capital is finite and you need to protect it like your life depends on it, because it does. All right. The next bit on risk management is you need to honor your stops without hesitation. You need to always remind yourself that you are paying the stop loss to do a job. And as humans, the amateur trader, for some reason, loves to intervene with that, and they love to exit manually because they can't handle the emotions of their stop loss being hit. Every trade that I go into, I just assume that that money has already left my account in the form of a business expense. And if that stop loss hasn't been hit yet, I tend to do nothing. So how many of you guys have been in a trade where you're up a little bit, the market starts retracing on you a little bit, it starts getting really close to your stop loss, and instead of honoring your stop loss, you exit manually to see the trade start moving your direction again. Whereas if you didn't do anything, didn't touch your stop loss at all, that market might turn around and trade towards your target again. But because you're making an emotional decision based on your P&L and not based on the chart itself, you have a point of invalidation. The trade is still valid until it takes out your stop loss. So having a logical stop loss in a place where the trade is no longer valid, maybe it's below a swing low or above a swing high if you are short. Until the market trades to that level, your trade is still valid. But again, the amateur traders will exit their trade as it's approaching their stop loss, only to see the market turn around and run to their take profit. So learn to stop making emotional decisions based on the stop loss, based on the P&L, and just let the market do what it has to do. It's going to wiggle around. The market doesn't move in a straight line, and you can't control what the market's going to do. So the most important thing is that you have a plan going into the trade, and you need to follow that plan religiously. There's absolutely no exceptions to this. Once you can master this, I guarantee you will find better results in your trading. All right, so let's talk about the different risk rules for funded accounts versus personal account. Now, I don't really treat different accounts any differently, whether it's a funded account or a personal account. My process is the same. I start by figuring out the maximum drawdown I am comfortable with, and then I decide how many fuel units I want to give myself to complete the journey with the best odds of success. So let's say I'm trading a funded account with $2,000 drawdown limit. What I'll do is take that $2,000 and divide it by the number of fuel units I want to operate with. For this example, let's say it's 20. That means each unit of fuel is worth $100 and I cannot burn more than $100 on any single trade. Now, I already know what you're thinking. Hamza, $100 per trade isn't enough to make a living. And this is where things get interesting. One of my biggest edges as a trader is that I love to scale into positions. So let's say I enter a trade using one fuel unit, $100 of risk. The market moves in my favor and logically I'm able to adjust my stop loss to a better location and take that original risk off the table. At that point, my first position is now protected. Worst case, it exits at break even. Now I can deploy another $100 fuel unit into the trade. The stop loss on the second position is set at the entry of the first position, which is already at break even. So if the market reverses and stops me out on both positions, I only use one unit of fuel. The other one gets refunded because it was never at risk anymore. So even though I scaled into the trade, my total downside never increased. This is real risk management, not just tight stops, but intelligent exposure. But here's the truth. Perfect risk management alone won't save you from the psychological trap that destroys traders with flawless entries and textbook execution. And this next point is where most traders either break through or completely break down. Number 4, focus on trading just one asset. Much like I mentioned in step number 1, where you will become the ruler of your domain, you'll also become the ruler of mastering a specific asset or a very select amount of assets. And the reason for this is because the same traders tend to trade the same stuff over and over again. And those traders have a specific habit and behavior to them. And once you can add that little detail to your strategy, you start to move to a whole new level. Now, this is also beneficial for the newer traders and for the struggling traders because it narrows down our focus. Instead of scanning through hundreds of stocks or pairs or assets and chasing those shiny objects every day, we've just got one singular focus going in one singular area. And when we combine that focus with that one little detail, then we can really take ourselves to the next level. Start with one asset and then slowly add maybe one or two. You can live the rest of your life trading the same 3 to 4 instruments over and over again. Keep it boring, keep it simple, and trade just one asset. So lesson number 5 is emotional decision making and revenge trading. I once lost $12,000 in 20 minutes because of this one emotion. The revenge trading cycle destroyed my first, 5, 10 accounts, but the simple journaling trick I discovered changed everything. Here's the brutal truth. Your biggest enemy isn't the market. It's the person staring back at you in the mirror. Every trader I've mentored has the same battle, and you are not alone in this struggle. One bad trade leads to 10 worse ones, and you lose $500, so you risk $1,000 to get it back, and then you lose that, so you risk $2,000, and before you know it, you've turned a small loss into account suicide. Trust me, I've been there. It's ugly. And I'm sharing this embarrassing moment because I want you to avoid the same pain. Revenge trading really is an ego problem. As humans in an industry where it's mostly male dominant, we just hate losing. We cannot take a loss and get off the screens. We want to prove to the market and everybody else that we are right about a specific trade, about some specific analysis. And I can tell you from the bottom of my heart, whenever I battled the market or I wanted to prove my friends wrong on a specific trade idea, it always came back and burned me because I took one loss on that idea and I needed to prove it to them and the market market and myself that I'm right about this analysis. And really, it just leads to spiraling losses. The biggest advice I can give you as far as revenge trading is you just need to get comfortable with the losses. Unless you are comfortable with the losses, you're going to continue to revenge trade and it's going to continue to burn you. Another big problem with emotions is fear, and that's because you just can't accept the uncertainty that is the market. Now, if you are a control freak, you're going to have a really hard time in the markets. Once you place a position, once you do the analysis, once you set your stop loss and take profit, there's absolutely nothing you can do about what the trade is going to do. It could go straight to your target. It could go sideways for a little bit. It could go straight to your stop loss, but you can't control that. And that uncertainty creates fear. So part of the experience that you're going to gain as a trader, which I can't pass to you, I can only talk about it, is how you feel when you put on risk. Honestly, the best trades that you're ever going to have should feel effortless. You shouldn't be expending tons of mental capital trying to manage your position. The markets are going to do what they're going to do. You cannot force them to go to your target faster. So oftentimes the best thing to do is not even look at the trade once you are in the position. You shouldn't be trading for excitement. We are here to make money. And oftentimes the market is going to do the heavy lifting. Once you are in the trade, just leave it alone and let the market tell you if you are right or wrong. Now, why do so many traders have such a hard time with their emotions? It's because they're not treating trading like an actual business. Okay, real businesses have real expenses. They are paying for vendors, they are paying their employees, maybe they're paying for inventory, and they need all these things to be profitable. And just like that, in trading, we need expenses in order to become profitable. But we need to limit those expenses. Okay, if our expenses get out of control and quote unquote our losses get out of control, then we can no longer operate our business. So when you sit down and look at your books, if you have very large expenses, you have to find a way to cut those expenses. So that means not moving your stop losses when the trade's going against you. Maybe it's your position sizing. Maybe you are consistent for a very long time and then you have one day or 1 week where you over leverage and now all of a sudden you have this massive loss on your books. If you want to find consistency, keep the position sizing proper. Make sure you're not moving your stop losses wider and make sure you're removing risk if the trade is going in your favor. Okay, a major hack when it comes to emotions in trading is journaling. And I'm not talking about journaling just my trades. I'm talking about journaling my emotions. It's very important once you are in the trade to write down how you actually feel. If the trade starts moving in your favor, how do I feel? If the trade starts moving against you, how do you feel? And what are the actions that you take when those emotions pop up? So you have these emotional triggers. And what happened to me for a very long time was when I felt fearful about a trade and I moved my stop loss wider because I didn't want to take a loss, or if I get super excited about a trade, maybe I scale in too heavily. These are all actions that are caused by my emotions. So those emotional triggers, once I could figure them out based on my journal, I stopped making those mistakes. And nowadays, I find so much more valuable data in my journaling about my emotions than I do for my actual trade data itself. So this simple practice turned me from an emotional wreck into a mechanical trader. Even if you master your emotions, there's still this patience killer that destroys accounts faster than bad entries. And most traders don't even realize they're doing it, which is lesson number 6. lack of patience and discipline. The market rewards those who wait but punishes those who chase. In my 6 years of trading, I've seen countless amateurs jump into trades too early or exit prematurely due to impatience. The market doesn't care about your bills, your timeline, or your need for action. It moves on its own schedule. And after 6 years, I can tell you with certainty that patience is the ultimate edge. Now, overtrading will kill your account faster than bad trades. Some days there's no good setups, and that's okay. Getting paid to do nothing is still getting paid. But the best traders are comfortable with boredom. Not only do you need patience in waiting for the right setup, but once you are in the trade, there's nothing we can do about that trade. We need to wait patiently to see if the market is going to agree with us or not. And I'm sure you guys have heard the saying before, but you don't want to destroy your account from death by 1,000 cuts. And that's essentially what I did for many years. I would enter an initial trade, and maybe if the market went against me, I would close that initial trade, enter in the opposite direction, and then I would get stopped out because it was going to my initial direction. I would get back in it, and it was just back and forth, back and forth, back and forth. And I was taking these small paper cuts. They would never be on A+ losses, but they would add up over time because I just didn't have the patience to let that initial position do its thing. The market does not go in a straight line. As much as we like to believe that, there's those one-off trades where you enter and it goes straight to your take profit. But what about the trades where you enter and then the next 5-minute candle maybe goes in your direction, and the next 5-minute candle after that goes against you, and you are now back at break even? If you just exited or flipped bias, you would take a loss on that specific trade. Whereas if you just entered that first position and didn't do anything, maybe by the end of the day, it's going to reach your take profit level. And this just came from realization where I was going back through my trades, and some of my trades I had were day trades. Okay, so I planned the trade on the 1 hour time frame, but then every 15 minutes I was changing my ideas, going back and forth. Once I was long, I would go short once the market went against me, and it looked like it was about to turn around, only for the market to slowly drift higher towards my target. And in that whole time period, maybe it was a 5-hour trade, it took hours to get to that target. I was in 50 different trades, taking losses in every single direction. If I just placed that one position and left it alone, did something else with my life, went outside, touched grass, played with my son at the park, did anything other than stare at the chart, I would be a profitable trader. And every profitable trader I know has mastered the art of doing nothing. Now, your trade exits, everyone says to hold your winners and cut your losers, but most people do the opposite. We are wired to take small profits because it feels good and then hold on to losses, hoping they are going to turn around because we don't want to be wrong. So big winners are rare. So when you get one, you need to make sure to let it run. Now, I have this very simple rule. If I enter a trade where my stop loss is 1 hour and I'm targeting 2 hour or 3 hour, I do absolutely nothing to that trade unless it's up 1 hour at least. If it's trading towards my stop loss, I don't do anything because I've had trades where it's gotten very close to my stop loss, turn around and hit full take profit. But that's because I'm so comfortable with the risk that I put on and the exit that I'm trying to plan. So when it comes to my exit, I tend to do nothing if it's under 1 hour profit. So let's say if you enter a trade and it's up half an hour, I don't do anything because I need to be able to have those winners pay for the losers. If you are not maximizing on the winning trades where you're getting 2, 3R, maybe even 4R multiples, your average loss should be, let's say, 1R. Your average loss, $100. Your average win, however, should be $200, $300, $400, $500. Either you need a high win rate with lower risk to reward, for example, 50 to 70% with a 1 to 2 or 60 to 80% with a 1 to 1 risk to reward ratio, or lower win rate with higher risk to reward. So 30 to 40% with 1 to 3, 1 to 4 risk to reward. As you guys know, we always aim for a 1 to 2 risk reward ratio because we know over a large sample size of 1,000 trades, we will average a win rate of 65 to 75% depending on the year. So 6 to 7 times out of 10, we will win double the risk. So if I go on a losing streak, I could lose 5, 10 trades in a row and I would still be up. But even the most patient, disciplined trader can still fail because of these mental barriers that most people don't even know exist. And I'm about to show you how to overcome them. Now, if you are serious about putting all this together into a complete system, I have something special for you. The Manipulation Model Mentorship is my comprehensive mentorship where I show you exactly how to apply these principles on live funded accounts. You get the strategy, the psychology, coaching, live trade reviews, and direct access to me and my brother. This isn't theory, it's the exact system I use to make 5 to 6 figures consistently in profits per month. Our students are getting funded and making consistent withdrawals using these methods. It's not for everyone, but if you are ready to stop making these mistakes and start getting consistent results, check it out in the description. But first, let me show you the mental barriers that trip up even the most disciplined traders. Lesson number 7: mental barriers and external distractions. Trading while working a 9 to 5 nearly destroyed my marriage. The mental game separates profitable traders from everyone else. I used to check charts during meetings, trade from bathroom stalls, and argue with my wife about missing the move. It was chaos disguised as dedication. Now, I'm sharing this embarrassing truth because I want you to learn from my mistakes and not repeat them. A lot of traders have a focus problem. So now I have specific trading hours where I'm 100% focused. No phone calls, no emails, no distractions. And when you're working a 9 to 5 job, that is very, very difficult to do. You are distracted by all these different things going on, and it's very hard to put your attention and focus into trading, which requires almost 100% of your attention at times, or at least that's what I thought. So unless you know somebody that's a full-time trader, this idea that we need to be glued in front of the charts 24 hours a day in order to become a full-time trader, that is just not true whatsoever. Now, when I'm talking about focus, I'm only talking about for a very specific amount of time. So when you sit down and do your analysis at night, you need 100% focus. And then when it comes for you to execute, that's when you need focus as well. But once you are in the trade and you have set your parameters, you have your entry, you have your stop loss, you have your take profit, there's really not much else you can do. You have to let that trade do what it's going to do. I thought that putting more and more focus into those specific trades would give me results, when in fact it did the opposite. I was more distracted at work, I was more distracted on the charts, and I just was not making proper decisions. So as you can imagine, when you are working a regular job or have your own business and you're putting all this extra effort into the markets, it doesn't give you better results. And I only noticed this when I sat down and took a good hard look at what gave me results in trading. Some of the best trades that I had was when I set my trade and didn't do anything. Okay, so many traders out there have a focus problem where they are putting too much focus on the markets outside of your analysis and your execution. And we really can't do anything. So what allowed me to leave my job initially was focusing on the style of trading that fit my current lifestyle, because I could not be in front of the charts all the time. I had meetings, I could not focus on intraday entries and exits. So I went to trade for just one session. And with this, I only needed to be on my charts for 1 to 2 hours a day. Now, with session trading, it just gives you so much more clarity to make decisions. If you are session trading, you only have to focus on what the current session is most likely going to do and frame a trade idea around it. In my case, it was the New York AM session. I would start at 8 a.m. Eastern Standard Time and end my session around 10:30 a.m. Eastern Standard Time, the latest. And the same principle applies for every other session. At times, I could only trade the London session or Asian session, sometimes New York PM session. You have to look at your schedule and find 1 to 2 hours where you can focus and trade. So you don't need to quit your job to trade successfully. And my most profitable students trade probably 90 minutes a day. They have systems. They are not gambling habits, and they plan their trades and they trade their plans. Now, pre-market rituals. I spend 15 minutes almost every morning drinking my espresso and going over my plan, checking my emotional state and settling my intentions. So this simple routine has prevented countless emotional trades because I'm aware of what I'm doing every single day. And after 6 years, I can tell you that preparation beats talent every single time. Now, those are the 7 core mistakes, but there are 3 advanced traps that even experienced traders fall into. And the first one will shock you because it happens right after you think you've made it. The first trap is the funding trap. Getting funded is easy, but staying funded is where the real battle is. Now, I know it's so easy to get excited about passing a funded account. You put it on this pedestal without realizing like the real battle starts once you get that funded account. You're so focused on the payout rules, the consistency rules, the drawdown rules, all the news rules that you lose sight of how to actually trade properly. And what I see happening with a lot of traders is they get extremely impatient and they want to hit the payout window as soon as it's available. So they force setups, they overtrade, they oversize, and it just ends in a blown up account. Now, this is really where all these prop firms make all their money. It's because all these retail traders, they don't have the patience to be able to trade for extended periods of time without getting paid. You guys have this specific timeline of I'm going to get funded and get paid out in 1 or 2 weeks. But the real way that you should be looking at this is, how do I keep the account long enough and how do I scale my capital? So maybe it's a money thing. If you have a 100K account and you are making $1,000, $2,000 and you're not realizing like, hey, this money isn't really changing my life a whole lot, you need to realize like scaling your capital to a certain point where making that $1,000 or $2,000 across 5, 6, 7, 8 accounts is now changing your lifestyle. So just think of it like this. It's all in numbers in percentage game. If you can make 1% on a 100K account, imagine what that 1% is going to look like when you are managing 500K or $1 million in funded capital. You're making 5 to 10 times as much with the same exact trades. So you need to be able to protect the accounts and scale the capital. If you are consistently blowing up your accounts, you can never scale your capital properly. Funded accounts are precious, so treat them like the rare opportunity that they are. You don't want to have to blow up your account and go through the long drawn out process of getting funded again, because during that evaluation phase you're not making any money, and the time that it takes to get funded again, you could have been making real money if you had just kept the funded account. But before you get funded, there's this one trap that keeps traders broke and searching forever. And it nearly cost me almost $50,000. And that is the information overload problem. So every trader out there, at least the ones that haven't consistently made it yet, realizes that more information doesn't equal more profits. Everyone thinks that they could go out there and find this one holy grail concept or strategy that's going to give them 100% confidence and profitability in the markets, and that's just not the case. So it leads you to constantly looking for new things and tweaking your strategy, and you never get comfortable with one specific system. You're always adding new things, and what you don't realize is adding new things to your system does not change the probability of the next trade that you take. It has the same probability. So just as an example, I don't know stochastics or harmonics personally, but even if I were to learn it, if I place a trade right now, it still has the same probability as if I didn't know it. If I come to the same conclusion with stochastics or without it, the market's either going to go up, down, or sideways. Me knowing something more is not going to change the outcome of that. And what you need to get comfortable with is no matter how much knowledge of a specific market or a specific strategy that you have, you are still going to have losing trades. There's absolutely nothing out there that is going to give you 100% strike rate. And what I found was the biggest thing that had impact on my overall profitability was not the strategy, and it wasn't new concepts. It was mastering risk management, getting better at trade management, and getting better at my emotional awareness. If you can master those three things, I guarantee that you can take an average strategy and make it excellent. And the huge misconception that most people think when they go full-time or they're consistently profitable trader is if they pour more and more hours into the charts and into the markets that they're going to become more and more profitable. The only thing that's going to happen from that situation is you're going to burn out faster. You're going to have less mental capital and you're going to make worse decisions because you are tired. And the whole point of getting into trading in the first place is so we can get our time freedom back. We don't want to just have another 9 to 5 desk job. And what you're going to realize at some point is that you don't need to spend a whole lot of time in front of the markets and in front of the charts. And in fact, the less time I need to spend in front of the charts to make my profit for the week, the better. So just remember that your time is limited. It's a scarce resource. So you need to stop consuming and just start executing. But here's the final trap that catches traders, even the ones who avoid all the others. It's the math that's going to humble you. No matter how smart you think you are, think about this. You could have 10 winning trades in a row and still be unprofitable. And I've seen tons of examples of this in my community and online where traders have 2 to 3 or 4 weeks of consistent profits. And then in 1 to 2 bad days or a couple bad weeks, they give back all of the profits. You guys need to realize that trading is very streaky. We're going to go on cold streaks. We're going to go on hot streaks. And it's about minimizing the damage during these cold streaks. So it's about accepting the probabilities of the market with the proper risk to reward. You only need to have a 35 to 40% win rate in order to be profitable. Now, if that makes you uncomfortable and you are uncomfortable losing that many trades, maybe trading is not for you. The key thing is that you're not consistent with your trade frequency or your trade sizing, which is holding you back. You need to be able to have the winners pay for the losers, and you are going to have losers. So if I can aim for a 3 or 4R on a consistent basis, think about how many losing trades I can take in a row. Let's say if I have 2 winners in a row, I would have to lose 6, maybe 8 trades in a row just to get back to break even. Now, when I'm always thinking about this math, it allows me to hold my trades for longer because I know if I consistently cut my trades at 1R or less than a 1R, maybe even a 1.5R, I know over time if I go on a losing streak, my P&L is going to be negative. And you are only going to realize this when you start taking really good account of your trading books. So just understand that you need to put your ego aside and realize that you're going to be wrong, and you're going to be wrong a lot during your trading career. Almost 30 to 40% of the time I'm wrong, but I'm able to accept that and maybe take a small loss or paper cut instead of widening my stop, taking a large loss or over trading because I think I'm going to be right. With these 10 lessons, you now have 6 years of hard-earned wisdom. But knowing these mistakes isn't enough. You need a proven system to avoid them. That's exactly what I'm sharing in my complete manipulation candle strategy video. You guys can check that out right here. Don't forget to like and subscribe, and I'll see you guys in the next one.